One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's nightmare winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. This is why I strongly encourage you to read about Bonner's 4th and final prediction totally free today. It's all spelled out in a free report we've put together about America's nightmare winter scenario. Get the facts for yourself. Go to americasnightmarewinter.com to get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, go to americasnightmarewinter.com for this free report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here on Stansberry Research in our brand new New York City studio, and here to inaugurate the space with me today. What an honor, what a thrill to have Alfonso Peccatiello in person with me of the Macro Compass newsletter. Alf, always good to speak with you via online chats, but amazing to have you in person.
Oh, it's my pleasure.
Welcome.
My pleasure. The studio is awesome, and an Italian in New York City.
And it doesn't get any better than that. So, and look at the coincidence. You're here the day that CPI coming out red hot, inflation showing right now no signs of slowing down. So the question that I'm going to be posing to you is what's next for the Fed? But I do want to bring it back to our last conversation, because when I asked you the last time, a few weeks ago when we spoke, saying, do you think they'll be successful in slowing down inflation? You said, it's too early to tell.
Yeah.
So you were right.
Yeah, indeed. So before I answer about what the Fed is going to do, just a quick analysis on the inflation number today. So you see that commodities, gasoline prices are going down, and this is reflected in certain components of the inflationary basket, but the sticky stuff is going up. It's not showing any sign of deceleration. And I'm talking about core services. I'm talking about rent of shelter, right? And why that is because when house prices go up, rents also with a lag tend to go up as the labor market remains strong. But these components are sticky and they're lagging. It takes a while before the Federal Reserve, with their tight monetary policy, is able to affect those components. And as we have seen today, they aren't able to affect those yet. So inflation remains kind of high, but most importantly, the sticky components, the components the Fed cares the most about, they are the last one to react. It's going to take a while.
So what do you think's going on now? They're looking at this number, and do you think they're thinking, what are they thinking?
Oh, they're very disappointed. They obviously are happy with the market reaction. So the bond market has priced now a terminal rate of 4.20%, 4.2%.
Right.
So that's pretty aggressive. It shows the market believes that the Fed is going to be aggressive. There is a 20% chance of a 100 basis point hike at the next meeting, which would be a historically large interest rate hike for the Fed. The equity market is tanking, it's down 3% last time I checked. So they are happy about, I think, what the market is interpreting their next reaction is going to be. They can't be happy about the underlying drivers. They see that the sticky
Right.
part of inflation isn't going down.
I also want to mention the yield on the 10-year surging 7 basis points, the 2-year soaring 17 points. I know the last time we spoke, you like bonds. Are you sticking to that?
Yeah, I think it's you indicated the 2 parts of the curve that are moving very differently, right? I mean, the front end, the 2-year bond yields, these ones simply can't stop going up until inflation actually slows down, because the Federal Reserve will just be forced basically to hike more and more until they break the inflation back or they break something else in financial markets. We'll figure out what they're able to do first. But the back end of the bond market instead is trying to follow the front end, but not as good as it is in front end in terms of yield rises. The curve is flattening, it's inverting further, which shows that the bond market knows that the more the Fed is tight today, the more long-term damage is going to do to the economy.
I think one thing that really stood out in the last interview we did, like really created a visual for me, you said, look, the Fed and the ECB are choking the economy. Can you just talk to us a little bit more about that?
Yeah, so what they're trying to do here is there are a lot of components in inflationary pressures that they can't affect. That's energy prices, that's supply bottlenecks. The Fed and ECB can't do anything about that. What they can do is more than offset on the demand side. So they can really kill and choke the private sector until they achieve their objective. They're not happy about that, but they'll have to do that. And how do they do that? Is by tightening conditions for all of us. And all of us means mortgage rates. That's the easiest thing you can think of. The housing market is gigantic and it sits on everybody's balance sheet. And by making mortgage rates higher, higher, and higher, they basically choke the access to the credit for who's trying to get a mortgage today. And it's not, I think, surprising that US housing prices are starting to cool off. And for the first time in 18 months, US houses are getting sold below asking prices, which is the first signal that when you put something for sale, actually, you can't expect a very strong demand because mortgage rates, the access to credit is becoming really, really tight. And in markets that are more leveraged in the housing sector, Canada, Australia, you start to see monthly house prices dropping by 1% a month, which if you annualize means 10 to 12% drop in a year. And that's one way that the Federal Reserve and the ECB, the central bank in general, have to cool down the private sector, hit the housing market. Later on, that will lower rents. It will also give us a negative wealth effect because our houses will be worth less. We will be spending less. They're trying to choke the private sector until they win the inflation battle.
What are your thoughts on the US dollar? We've seen the brakes placed a bit on the dollar. Yeah. It doesn't have the same trajectory as it did. Was this purposely done, do you believe?
No, I think it was a bit of a market settling. I mean, after the dollar has basically gone up 20% in a year, I think it's okay to take some profits here and there. That's what most investors must have thought. But if you think on a longer term perspective, what's going on here is that the Federal Reserve is trying to make hoarding dollars more rewarding. We discussed about that in one of our previous interviews.
Right.
But if you think of asset classes that are priced in dollars, so you think about gold or house prices or the stock market, right? If you focus on the denominator, so the dollar itself, what the Federal Reserve is doing by raising interest rates and putting real interest rates into positive territory back again, is it's making owning the dollar, hoarding them,
right,
more rewarding than it was a year ago, which means all asset classes priced in this dollar, in this denominator, have a hard time rallying because the denominator itself is getting more reward.
Well, okay, for gold investors specifically, listen to this. That would make sense here because they're scratching their heads saying, gold should really be rallying here. Yeah. But as you said, this is really the reason?
Yeah, I think, gold is priced in dollar. It's the typical asset that it doesn't produce cash flows. It maintains its purchasing power over time. That's the design of the asset class, right? To protect your purchasing power in the long term. But it's priced in dollar. The denominator is getting temporarily stronger, and that affects gold in the short term. I do think that gold will be one of the first asset classes to rally once the Federal Reserve...
You do?
Yeah, I do think it's going to be one of the first asset classes to buy. It's going to be one of the first asset classes to rally, because when the Federal Reserve has achieved enough progress on the inflation front, and they can stop with this tightening process, but the economy out there still looks pretty bad, because imagine all the damage we're going to do over time, gold is going to be one of the assets that is going to benefit the most.
So to that point, is this causing Alf to take a step back saying, well, maybe I should be buying some of these asset classes now that they're...
So as my mentor used to say, Daniela, when taking risks, that being very early is also being wrong. So what my assessment has to be here is, look at the time horizon ahead of us and try to protect our purchasing power and our capital as best as we can over the next 3 to 6 months. When we have more signs that the Federal Reserve and the ECB are winning their inflation battle, then it's going to be time to reload on certain assets, and gold is going to be one of the first I'm going to be looking for.
Okay, want to switch our focus now to one of your latest pennings focused on what's going on with Europe, Putin, the energy crisis over there. My big question to you is, because I'm reading all the headlines coming out of Europe. You're living there right now. I want you to tell us the real deal, the real story, because the divergence in headlines, I'm reading The Guardian saying, actually, it's not going to be so bad for Europe. There's enough supply. It's not as catastrophic as we thought. I'm reading another report saying, no, we're basically, Europe will be buckling at its knees here this winter. Where do you see things going here?
Yeah, so the article was named The Long War, the Macro Compass article, because I don't think it's something we're going to sort out in Europe in this winter. But so let's discuss the short term first. So Putin's strategy is very clear. He's trying to basically make sure that there is no gas reaching Europe at all this winter. And so when it comes to is Europe going to make it or not through winter when it comes to energy availability, there are two components to consider. The first is the stock of gas that Europe has been able to accumulate so far, and that's looking pretty good because Europe, of course, knows that Putin isn't going to deliver, so they try to get gas, very expensive energy sources, from elsewhere to increase their stock ahead of winter. The problem is that you start with a stock, but you're going to be using it. You're going to be dwindling the stock over time in winter as you use energy to heat, etc., etc. So the flow is another thing, and the flow depends on Russia. Russia isn't going to deliver any, and the flow depends on the weather. And that's the interesting thing, because if the winter is going to be very cold, then you're going to be using more energy, and so the stock will go down fast. There is no flow, and you're going to have a problem. Now, if I make a rational assessment and look at all possible scenarios out there, I think Europe will just make it through winter. Now, is that good? No, it isn't. It's pretty bad. We're talking about a developed economy that will just make it through winter with their energy. That's not looking great. That's the short term.
I mean, and how does it affect? I mean, we're both, Italian, south of Italy, where wages are not that high. I'm using this area because we both know it well. How can the average person survive that? Will they make it? The average one.
That's a very valid point. So when I say Europe is going to make it, it means there's going to be enough energy in my base case to avoid wide shutdowns of economies, right? Okay, that's one thing. What about the hit? What about the cost of that? And that cost I estimate being in the 7 to 10% of GDP. It's very, very large. We're talking about a financial crisis, basically, in terms of size. And who gets that hit is the private sector. That's what we knew until 2 weeks ago, where basically energy bills were going through the roof. And as you say, salaries weren't increasing at the same pace. So, things don't square. Governments decided to stop the bleeding, partially protect the private sector by taking some of the hit. So you've seen that in the UK with a wide announcement that the energy bill isn't going to be higher than 2,000 a month. So they're trying to cap, basically, energy prices for the private sector. But Daniela, this is basically using the government balance sheet to protect the private sector, which is a sort of a survival bias from governments because they want to kick the can down the road and they cannot transfer the full bill to the private sector. Otherwise, companies will go bust, families won't make it.
Of course.
And what you're doing is you're using the government balance sheet, which means you're printing more euros, you're printing more sterlings, you are taking the losses. Instead of the private sector, you're putting them on the public balance sheet. So that sort of is a band-aid. It helps to survive in the short term, but the government can't print electricity, the government can't print gas. So that's why the title of the article was The Long War, because this is not going to be sorted out in the winter or not. And that part, the long war, deserves more attention.
Very good food for thought. Before I let you go and continue your stay here in New York, are you enjoying the city? And most importantly, have you found some decent food?
The answer to the second question is not yet, but I'm confident I will. Actually, I will ask some suggestions to somebody who really knows about food like you. The city is awesome, by the way. Yeah. It's very active. There's a lot going on. It's really New York City. It never sleeps.
Definitely.
And it's a fascinating place to be. I just miss my pizza, though.
Well, I don't know if this this will help. I've been here 9 years and I'm still... Actually, there's one pizza place. I'll tell you offline. I'll share it, my secret. Alfonso, è stato veramente un piacere. Thank you so much for coming, and thank you all for watching. We'll have more incredible content coming your way, so be sure to stay tuned to Stansberry Research, and don't forget to sign up at danielacamboni.com so you can stay on top of all our great interviews. That's it for me from our New York City studio. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.